Hello, dear viewers, and welcome to yet another episode on the series GST in Pictures. We have grown in the subject of GST, and in today's episode, we are going to learn a very interesting concept, and that is reverse charge mechanism. How does this concept of reverse charge mechanism work? It's a very unique concept that we have under this subject matter of GST. We will look into some ideas as to how this concept of RCM works. What is the basic idea of collection of tax? Who pays tax under GST? So let's look at, and we will look at a few examples as well. So what are the topics that we are going to cover in this particular session? We are going to cover registration under GST, GST, the basic application, who is supposed to pay tax, then the meaning of reverse charge mechanism and its application, and finally, we will take a few examples of reverse charge mechanism. So let's understand the concept of registration under GST. We have learned under GST, there are only two kinds of registration possible. Either the person registers under normal scheme, suppliers registered under normal scheme, or we say suppliers registered under composition scheme. But there are a set of suppliers who are not registered at all. There is a threshold limit of 40 lakh rupees as far as a normal scheme registration is concerned. Then under composition scheme, we have a threshold limit of less than 1.5 crores. And for special category states, it is 75 lakhs. But there are quite a few suppliers in our country who remain unregistered. So what about them? Can a buyer or a recipient who is registered under GST, can they transact or do business with unregistered suppliers? All these points we are going to cover in this particular session. So either a supplier is registered under normal scheme or a supplier is registered under composition scheme, that is under section 10, or a supplier may remain unregistered, not taking registration under GST at all. So let's understand the basic rules of GST. When it comes to the inward or outward supply, collection or payment of tax, that is input or output tax that we pay, who is liable to pay GST to the government? Understand. Let's take intrastate transaction. In case of an intrastate transaction, intrastate means both the buyer and the seller are from the same state, or both the buyer and the seller are from the same union territory. So recipient and suppliers are from the same state or same union territory, and the supplier is registered under normal scheme. So supplier is registered under normal scheme. Next, in case of interstate transaction, so buyer and seller are from two different states, or one state and one union territory, or the recipient is based in one state, the supplier is based in another state, and the supplier is registered under normal scheme. Then third thing that we will take, very important, in case of intrastate or interstate transaction or imports from a foreign country where the supplier is not registered. This is a very, very important point. Supplier is not registered, or if the supplier is registered under composition scheme, that is for intrastate transactions only, because a composition dealer is not supposed to sell the goods interstate. So as far as composition scheme registration is concerned, that will be applicable for intrastate transactions only. So let's understand this particular concept. Now, supplier is going to make an outward supply of goods to the recipient. Supplier is registered. So definitely the recipient will have to pay GST to the supplier, apart from the cost of the goods. Let us focus only on the GST part. So supplier is going to receive GST amount that will be treated as an output tax from supplier's point of view. So supplier, after he has received the GST amount for an intra-state transaction, the supplier will deposit 50% of the GST amount with the state government where he is based, and the remaining 50% will be deposited with the central government. That is, for an intrastate transaction, the supplier is going to receive GST amount, and their GST will be apportioned into 50%. 50% will be given to the state government, and the remaining 50% is given to the central government. Now, if it is an interstate transaction and supplier is registered, so when we say supplier is registered, definitely the supplier is going to collect GST amount. And whatever is the GST amount, that IGST amount rather, that the supplier is collecting, entire IGST amount will be deposited with the central government. Then it is the responsibility of the central government to share 50% of the revenue with the state government where the recipient is based. Suppose, let's take an example. Supplier is based in Karnataka and the recipient, the buyer, is based in, say, Hyderabad, Telangana state. So the recipient in Telangana, Hyderabad, is going to pay GST to the supplier in Karnataka. Since it's an interstate transaction, entire amount of IGST will be deposited by the Karnataka supplier with the central government. After that, the central government will retain 50% of the GST amount, and the remaining 50% will be shared with the Telangana government, because it's a destination-based consumption tax, we say, because consumption of goods happens in Telangana, in Hyderabad. So 50% GST revenue will be shared with the Telangana government. Now here the supplier was registered. So it was very easy for the supplier to collect GST amount and deposit the entire IGST with the central government, and central government will share 50% of the GST revenue with the state government where the recipient is based. Now, in case of intrastate or interstate transaction or imports, supplier is not registered. So let's be very clear. Supplier is not registered, meaning to say supplier cannot collect GST amount because the supplier is not registered. Or if the supplier is registered under composition scheme, that is for intrastate transaction only. So if the supplier is registered under composition scheme, again the rule says supplier cannot collect GST. Those who are registered under composition scheme, that is section 10 of GST Act, such business persons or such suppliers cannot collect GST from its customers. So what happens over here? Reverse charge mechanism will become applicable. That is RCM. Reverse charge mechanism will become applicable in this particular situation. So let's understand this concept of reverse charge mechanism in detail. Now, before we proceed further, we have to understand the basic point. Supplier will deposit GST amount. Supplier will deposit IGST amount. So if you see, it is the responsibility of the supplier to deposit the GST amount with the government, state government and central government, or entire IGST amount with the central government, as you see over here. So supplier's responsibility to deposit GST amount with the government. So let's look at the concept of RCM in detail. What is the meaning of reverse charge mechanism? So as we understand, under reverse charge mechanism, the usual cycle of tax payment is reversed. Supplier was supposed to deposit GST amount with the government. Now, under reverse charge, see, as we say, the reverse means the opposite. Here, the supplier does not deposit, rather the recipient is depositing the GST amount with the government. So reverse charge means the liability to pay tax is on the recipient of the supply of goods or services. See, in normal circumstance, the supplier should deposit GST amount with the government. But in case of reverse charge mechanism, it is the responsibility of the recipient of goods or services instead of the supplier. Reason? Supplier is unregistered. So supplier cannot collect GST. But if the recipient is registered, it becomes the responsibility of the recipient to deposit the GST amount with the government. So instead of the supplier depositing, the recipient of the supply of goods or services is liable to pay tax to the government. That is in respect of notified categories of supply. So that's why we say the usual cycle of tax payment is reversed. The normal circumstance is supplier paying GST to the government. But under reverse charge mechanism, since the supplier is not registered, or if the supplier is registered under composition scheme where he cannot collect GST, if the recipient is registered, the recipient is supposed to deposit GST amount with the government. That's why it is called as reverse charge mechanism. And the recipient is supposed to deposit GST with the government in case of RCM if he is if he requires the benefit of claiming input tax credit. Remember this. So usually he gives to the supplier, but since the supplier is not registered, supplier cannot collect GST. So recipient himself or herself will deposit the GST amount with the government. That is called as reverse charge mechanism. Let's understand the application of reverse charge mechanism. Recipient is registered. See, earlier we said supplier is registered, so he could collect GST. Now we talk about the recipient. Recipient is registered, but the supplier is not registered. Supplier is unregistered. Next part is if the supplier is registered under composition scheme. We just discussed about it. So if the supplier is unregistered, that is a normal unregistered part we say. Normal unregistered dealer, or in case of imports. Let's say, for example, I am importing goods from London. It's an interstate transaction. London, the person or the exporter in London need not register under the Indian tax laws. So need not register under GST. But the recipient, the one who is importing the goods, I am importing the goods. Suppose I am registered under GST, I am liable to pay IGST to the central government. So either unregistered dealer or in case of imports, we will be discussing that. We'll take examples. Second part is the supplier is registered under composition scheme. I just mentioned if the supplier takes registration under section 10, that is under composition scheme, composite dealers are not eligible to collect GST from its recipients. So composite dealers cannot collect GST from its recipient. This is a very, very important point. So let's be very clear. So any business person or any supplier who is registered under composition scheme cannot collect GST from its customers, cannot collect GST from its recipients. Let's take a set of 4 examples. First example we will take X from Mangaluru, Karnataka, an unregistered supplier. So X is not registered, he is unregistered. He is making an outward supply to a registered recipient Y of Bengaluru, worth rupees 40,000, GST rate is 12%. Now X is from Mangaluru, Y is from Bengaluru. So both these towns, both these cities are based in Karnataka. So it becomes an intra-state supply. So it is an intra-state supply. Now since X is not registered, X cannot collect GST. Since X is not registered, X cannot collect GST. And therefore Y is a registered recipient. So Y is supposed to pay 12% GST under reverse charge mechanism. Now, since this is an intra-state transaction, 6% of 40,000 will be deposited with the Karnataka government because the recipient is based at Bengaluru. So Karnataka state will earn revenue, 50% GST portion. So 12% GST. So 6% to the Karnataka government, that is 40,000 into 6% to Karnataka government. And the other 6% on 40,000, that is 2,400 to the central government. So if it's an intrastate supply, instead of X collecting GST, he cannot collect because he is not registered, but Y is a registered recipient. So on behalf of X, instead of X, Y is going to deposit. The recipient is going to pay GST to the government. So this is a clear-cut example of reverse charge mechanism. That's about intrastate supply. Let's take another example. A from Mangaluru, an unregistered supplier. So A once again is an unregistered supplier, makes an outward supply to a registered recipient B of Hyderabad. So Mangaluru is based in Karnataka, Hyderabad is based in Telangana. So very clearly, it is an interstate supply. Transaction value, taxable value of supply is 90,000 and GST rate is 18%. Now, since this is an interstate supply, IGST will become applicable. Integrated goods and service tax will become applicable. Point is very simple. A cannot collect GST because A is unregistered. But since B is a registered recipient, B will deposit IGST amount, entire amount, 18% on 90,000 with the central government. So as per the rule, A cannot collect GST because he is unregistered. And therefore B, recipient, is supposed to pay 18% IGST. 18% of 90,000 works out to 16,200 rupees. So this entire 16,200 will be deposited with the central government, and central government will share 50% revenue. That is 8,100 with Telangana government, because the recipient B is based at Hyderabad. Destination based consumption tax. So 50% revenue of this will be shared by central government with the Telangana government. So 8,100 thereafter will be shared with Telangana government. Let's look at another example. A supplier P from Daman and Diu, Union Territory, he is an unregistered supplier. He is making an outward supply worth rupees 50,000 to a registered recipient Q of Bengaluru. So from one Union Territory to a recipient based in another state. So this is also an example of interstate supply. That is, one Union Territory and one state is good enough for interstate supply. Transaction value, taxable value of supply is 50,000. GST rate is 28%. So since this is an interstate supply, IGST will become applicable. That is the first point that we need to understand. Now, question is, can P collect GST amount? P cannot collect GST amount because he is not registered. He is not registered. So instead of P, Q is going to pay on his own IGST amount to the central government. Because this is an interstate supply, IGST will become applicable. So as per the rule, P cannot collect GST because he is unregistered, and therefore Q, the recipient, is supposed to pay 28% on this 50,000 rupees. So 28% of 50,000 works out to 14,000 rupees. So 14,000 IGST will be paid by Q directly to the central government, and thereafter the central government will share half of this 50%, that is 7,000, with the Karnataka government, because the recipient is based in Bengaluru in Karnataka, destination based consumption tax. So central government will share 50% IGST revenue with the Karnataka government. We'll take one more example relating to imports. D, a registered recipient from Chennai, is importing goods worth rupees 1 lakh from E of Singapore. So Singapore is another country, so imports are happening. Now, D, the importer, is a registered recipient. But the point is, Mr. E, who is based in Singapore, he need not register under GST, first part. Second part, very important, he is outside the taxable territory as far as GST is concerned. And this imports is also an example of interstate supply. So it is an example of interstate supply, specifically imports. Now, E definitely is not going to collect GST because he need not registered. Second party is outside the taxable territory because he is based outside taxable territory. That is, he is based in Singapore. But since D, the importer, is a registered recipient, D is going to pay IGST amount because it's an interstate supply, IGST amount with the central government. So D, the recipient, is supposed to pay 12% IGST under reverse charge mechanism to the central government. So 12,000 will be the IGST amount that D will deposit with the central government, and the central government will share 50% of the revenue, that is 6,000, with the Tamil Nadu government, because the recipient is based in Chennai in Tamil Nadu. So 50% of the revenue of this 12,000 rupees, which works out to 6,000, will be shared by central government with the Tamil Nadu government. So I hope these four examples are very, very clear as far as reverse charge mechanism is concerned. So in a normal circumstance, the supplier is supposed to deposit GST with the government. But in case of reverse charge mechanism, either the supplier is not registered or the supplier is registered under composition scheme. So in both the circumstances, the supplier cannot collect GST. But since the recipient is a registered recipient, the recipient himself or herself will deposit GST amount with the government. And since instead of the supplier doing the job, the recipient is depositing tax with the government, so that is called as reverse charge mechanism. So I hope this concept of reverse charge mechanism and these 4 examples are very, very clear. So if you would like to connect with me, this is my email ID, my number. So thank you very much. And any questions that you have on this particular concept of reverse charge mechanism, you can feel free, you can share it in the YouTube link, and I'll be more than happy to answer all those questions. So thank you for your patient hearing.